The Instruction Manual for the AI Era, a comprehensive guide to ARM Holdings, ARM. As of January 17, 2026, ARM Holdings has solidified its position as the most pervasive technology company on the planet. While NVIDIA builds the engines of AI and TSMC builds the factories, ARM provides the blueprints. If you are reading this on a smartphone, an iPad, or a modern Mac, you are using ARM. For an investor in 2026, ARM is a royalty machine at the center of every major computing trend. This guide breaks down the company's unique business model, the high-margin V9 transition, and the growing risks of open-source competition. 1. The business model: intellectual property, IP, at scale. Unlike Intel or AMD, ARM does not manufacture chips. It doesn't even sell physical products to consumers. Instead, it creates the instruction set architecture, also known as ISA, the fundamental language that tells a computer chip how to process data. How ARM makes money: licensing. Companies like Apple, Samsung, and NVIDIA pay an upfront fee to access ARM's blueprints. In early 2026, this segment is booming as companies scramble to build custom AI chips. Royalties. This is the forever revenue. For every single chip sold that uses an ARM design, ARM gets a small percentage of the chip's price. Because there are roughly 30 billion ARM-based chips shipped every year, these pennies add up to billions in recurring, high-margin profit. 2. The 2026 catalyst: the ARM V9 revolution. The biggest story for ARM investors in 2026 is the rapid adoption of the ARM V9 architecture, the royalty multiplier. The shift from the older V8 to V9 is a massive financial win. Higher rates. Historically, ARM collected a royalty of about 1 to 2% on older designs. The V9 architecture, which includes specialized AI instructions, commands a royalty rate of roughly 4 to 5%. The adoption curve. As of January 2026, V9 has moved from high-end only to the standard for almost all mid-range smartphones and AI data centers. This allows ARM to grow revenue significantly even if global device shipments remain flat. Compute subsystems, CSS. ARM has moved up the stack by providing CSS, where they offer nearly a ready-to-bake chip design rather than just the blueprints. By doing more of the heavy lifting, ARM is now capturing royalties as high as 8 to 10% in some segments. 3. The data center pivot: challenging x86. In 2026, the data center, once dominated by Intel, has become ARM's second largest growth engine. Neoverse, the cloud king. ARM's Neoverse platform is designed specifically for servers. The world's biggest cloud providers have moved to custom ARM chips to save on electricity. Amazon, Graviton 5, now powers over 50% of new AWS CPU capacity. Microsoft, Cobalt 200, deeply integrated into Azure's AI infrastructure. NVIDIA, Grace Blackwell. The Grace CPU is an ARM V9 design, meaning every Grace Blackwell superchip sold generates a royalty for ARM. The efficiency advantage: ARM chips use significantly less power than traditional chips. In 2026, with power grids struggling to support AI, performance per watt is the most valuable metric in the industry. 4. Financial performance: high valuation, high scrutiny. As of January 17, 2026, ARM is a polarizing stock. While its business is flawless, its price reflects extreme expectations. Key metrics: early 2026. Stock price: approximately $105.11, reflecting a 28% decline over the past year as the AI hype cooled into reality. Price-to-earning ratio: approximately 134 times. This is significantly higher than the semiconductor industry average of 42 times. Gross margins: a spectacular 97%. Because ARM sells digital designs, almost every dollar of revenue is pure profit before operating costs. Market capitalization: approximately $110 billion. 5. Critical risks: the anti-ARM case. The rise of Risk 5. The biggest long-term threat is Risk 5, an open-source, free alternative to ARM. In late 2025, major customers like Qualcomm, which recently acquired Ventana Micro, signaled a deeper shift toward Risk 5 to reduce their reliance on ARM's fees. China risk. In fiscal 2026, China remains a major revenue source, approximately 20%, but growth there has slowed to single digits. The Chinese government is aggressively promoting Risk 5 to achieve chip independence from Western licensed technology like ARM. SoftBank's ownership. SoftBank remains the majority owner. If SoftBank decides to sell a large portion of its remaining stake to raise cash for other investments, it could create a supply overhang that suppresses ARM's stock price. 6. Investment strategy for 2026. The toll booth play. Invest in ARM if you believe in the ubiquity of computing. You aren't betting on which phone wins, you're betting that every phone needs a brain. Watch the mix. The most important metric to watch in 2026 earnings calls is the V9 as a percent of total royalties. If this keeps rising, the profit story remains intact. Valuation caution. Because ARM's PE is so high, the stock is hypersensitive to news.
It is often better to dollar cost average into a position rather than buying all at once. Conclusion: the pulse of global tech. ARM is the only company that touches nearly 100% of the connected population. In 2026, it is no longer just a mobile company. It is the fundamental architect of AI infrastructure from the data center to the palm of your hand. While the valuation is steep and competition from RISC-V is real, ARM's massive software ecosystem and high-margin royalty model make it a cornerstone of the modern technology sector.